Um, Good evening, everyone. My name is Jen Ellington. I'm the Interim Executive Director for the Entrepreneurship Center. So, very excited to have you here and to kick off the new year with a continuation of our newest speaker series. Some of you may have joined us back in December when we had a number of panelists speak to kind of Apple and Google coming to the Triangle, what that means for the ecosystem. So we're excited to continue that innovation series, as we're calling it. And today we have Scot Wingo joining Jason Doherty for a conversation about the Triangle Tweeners List, the Triangle Tweeners Fund, and just what companies we need to be looking for and keeping an eye on in the 2022 year. So glad to have everybody here. Again, just to iterate what Aspen had said earlier, if you don't mind putting yourselves on mute, feel free to use the chat function and ask questions along the way. And Jason and our team will be sure to direct them to Scott as they come in and as we get to the Q&A session. And, feel free to share thoughts and talk to each other and have the conversation going as well. And with that, I'd like to turn it over to Jason. Jason is our clinical associate professor who teaches entrepreneurship. And so he will be having this conversation with Scott. So Jason, thank you.
Thanks, Jen. Welcome, everybody. It's nice to see such a large group here today. Really excited to be hosting this session with Scot Wingo. So as Jen said, I'm Jason Doherty. I'm a faculty member at UNC at the business school and a member of the Entrepreneurship Center team. So many of you probably know Scot Wingo or at least know of him. And we're really fortunate to have him here today. He's been, I think it's fair enough to say, a driving force in the entrepreneurial ecosystem in the Triangle for a lot of years. So I'm really excited to get a chance to pick his brain a little bit about the startup ecosystem, the kind of trends that he's seen over the last decade plus, and especially as it relates to the Tweeners List and the technology startup ecosystem that we'll be talking about. So, like I said, Scot's been in the Triangle area since he came here for his master's degree program at NC State. He went off to work in a startup and then came back to the Triangle area and has started a number of companies here, including Channel Advisor, which he's still a board member of, and which he took public back in 2013. He's currently the CEO of Spiffy, which is a venture-backed company disrupting the car care industry and has been really active. But I think where Scot's perspective, in addition to being a serial founder, I think his perspective is really valuable with respect to the work that he's done in developing the Tweeners List, which I'll let him tell you more about and introduce to you. But it's really been a valuable asset for us in this ecosystem as we try to understand who are the startups that are growing and scaling in this ecosystem and having an impact on our business climate. So with that, Scot, love to have you kind of introduce yourself a little bit more and tell us about the Tweeners List and kind of what the rationale was for getting that started, and then we'll jump into some questions.
Yeah, thanks, Jason and Jen. Thanks for having me today. I love to talk about entrepreneurship, so this is a great group for me. So just a little bit about me. I'm from the middle of nowhere, South Carolina. It's called Aiken. So unless you're into horses, golf, or nuclear reactors, you probably haven't heard of Aiken. So I went to the University of South Carolina undergrad in computer engineering. I was kind of a super nerd, if you can't tell by my Star Wars collection here, and then went to NC State and fell in love with the Triangle area. And as Jason mentioned, got my first job up in Connecticut and at a startup and realized I love startups, but not cold weather. So I've kind of worked on 4 startups over my career. The first one was called Stingray Software, and that was developer tools for Visual C++. and sold that right before my 30th birthday. One of my in the startup world, we use this phrase BHAG, big, hairy, audacious goals, BHAGs. If you haven't heard that, it's from a famous Jim Collins book. When I was 17, I didn't know to call it that, but I came up with two BHAGs. I wanted to take a company public and be a millionaire by the time I was 30. So I was able to check one of those off the box with my first company. And then the internet bubble was growing after that, and I started a company called Auction Rover, which lets you search across the internet, across auction sites. In the early days of e-commerce, it didn't look like today. It was mostly auction sites and a couple of fixed price sites, and that has obviously inverted. So we built a search engine for that and sold that to a public company. And then the kernel of the idea for my third company came out of that, called Channel Advisor. Started that in 2001, raised $90 million in venture capital, and went public in 2013. So I got to check that second thing off of my goals. And then during Channel Advisor, I bought a car wash, and then I had my first Uber experience. And for me, I felt like someone had to marry those things together and approach. So I kind of view it as Channel Advisor was digitization of the retail world, which is consumer products. If you look at GDP, consumer products are 5 trillion. 10 trillion is consumer services. So I felt like services were going to go digital, just like I had seen in the world of e-commerce. So started Spiffy to take advantage of that. So hopefully that gives you a little bit of kind of my background. In the Q&A, I'm happy to go into any of those things. When I talk to students, I get lots of good questions there. My biggest message, if you have one takeaway for this, it's that anyone can do entrepreneurship. When I talk to a lot of folks today, they feel like they have to be Bill Gates or Mark Zuckerberg, and those are awesome, or still Steve Jobs, and those are awesome entrepreneurs for sure. But I come from a upper lower class family. Nothing, I'm not a trust fund kid. South Carolina, NC State, so I didn't go to Ivy League or any of that kind of stuff. And I've been relatively successful. And the second thing to take away is, so not only can you do what I've done, if I can do it, you can do it. But the second one is the Triangle is a great place to start a company. So I know a lot of you may have moved to the Triangle from other places, and maybe you're thinking of going home. That's fine. But what you find is the Triangle has this pull on people. Even now, I'll find people that are kind of like, hey, I've been at Google for 30 years and I want to get back to the Triangle. So whether you stay or come back, we'd love to have you back in the Triangle. I'm unofficially the Mayor McCheese of the Triangle, I like to say. Yeah. So that's my brief background.
Awesome. Thanks for the background on that. Scott. So I think it was in between the Channel Advisor years and the Spiffy years when the Tweeners List kind of got started with you, and love to hear from you just kind of the genesis of that. And yeah, it looks here from your slide, you've got kind of an explanation of where the Tweeners sit in the sort of startup life cycle. So I'd love to hear kind of what your perspective is on that. And I think it's also important to highlight what sort of is in scope and what's out of scope for the Tweeners List as well.
Yeah, absolutely. So I started my first company and I had no idea what I was doing. It was called Stingray. And but I went to NC State and I met this professor there that was in entrepreneurship. So I got, started Stingray and then really got into, a million questions pretty quickly because I have no business background at all. So I was basically drowning. And he said, well, let me connect you with some folks. So he connected me with 3 or 4 previous entrepreneurs that had been through NC State. And that's where I learned kind of one of the most interesting things about the Triangle is there is a set of, there's a mindset of giving back to the community. So these folks helped me and gave me like tons of free advice. I kept expecting there to be an ask like, oh, and I want 10% of your company, or if I help you sell your company, I want some percentage, but there was never an ask. And finally I said, I've taken a lot of your time. Is there some way I can I got to the point where it was awkward for me. I love free stuff, but it was kind of like, I'd eaten at the free buffet for so much. I was kind of like, there has to be a catch here. And I finally said to one of my mentors, Richard Holcomb, I was like, there's got to be a way I can give back. He said, no, what we do here in the Triangle is we pay it forward. So I'm paying it forward to you, and I want you to do the same thing. So I've taken that very seriously, and I've tried over my career to pay it forward. So if you look kind of from 95 to today, in that first chunk of time, a lot of giving it back was kind of that same thing, one-on-one mentoring. And then a lot of it was in the early days of the Triangle, so call it 95 to 2012-ish, 2010. It was convincing people to be entrepreneurs. We had a lack of entrepreneurs. So if you think about a typical sales funnel, we didn't have much in the top of that funnel. And in startups, you have kind of this nascent startup, someone with an idea. We didn't really have that. So I spent a lot of my time convincing folks like Robbie Allen, who had developed this kind of idea. You guys will love this. He's a statistician, and he was at Cisco, and he's obsessed with UNC basketball. So he pulled in all the stats from UNC basketball into this thing called Stat Sheet, I think is what it was called in the early days. And he could look at these correlations between, if this referee was reffing, the probability, the Vegas odds would be this, and then the probability of winning would be that. And it was really fascinating, all the things he could pull together. And he wanted to do it for every team, but he was kind of worried about leaving Cisco. So a lot of my giving back was convincing people to be entrepreneurs, that you wouldn't starve and you'd be okay. Then between Channel Advisor and Spiffy, I was kind of like, all right, I've got some time. Let's go see what's going on. And what happened is it looked like this. There were so many startups in the Triangle, you couldn't tell. I could tell there was some nuggets in there, but I couldn't tell where they were. So and then I went and looked, and no one had kind of said, hey, here's the set of companies kind of in the middle. Using this funnel terminology, you have kind of the top of the funnel, kind of the middle, and then the bottom of the funnel. So we had a bottom of the funnel. Everyone knew who at that point in time, like Bandwidth was and Channel Advisor, because they were scaled up and getting towards an IPO. But then there was just like so many startups, you couldn't kind of pick the ones out. So my thought was, we need more at the bottom, and to do that, we need to define the middle so we can kind of get them from the primordial soup of startup to the middle to the final outcome, which typically is a big acquisition or an IPO. My stated preference is I prefer IPOs, and I'll kind of explain why. So the Tweener List was this way of it solved a couple of problems. It was a way of saying, here's the companies in the Triangle that are on the move, and we as an ecosystem can now focus on, because we've got this really nice top of the funnel. Let's get some more people down a level. And I use the word tweener. I like to invent phrases. So it's a weird hobby of mine. If you ever heard of Shipageddon, that was one of mine. And then zero friction addiction is another one. And anyway, so I kind of, in the early days, I called it the Goldilocks list, but it's kind of like it didn't really stick. And it kind of like took people down a weird path sometimes. So the tweener list is kind of takes this idea of something that doesn't quite fit in a definition, call it a tweener. It's not a teenager kind of thing, and apply it to companies is kind of sticks in people's heads. So I liked that. So that was the genesis of the Tweener List. And then let's see, you asked what is a tweener. So I kind of backed into this. So in the early days, and I think the first list was 2015 or 16, I wanted a list that was big enough so people would look at it and be like, oh, there's three. Having it be 3 isn't useful, but having it be 300 isn't useful either. So I kind of said around 50. So at that point in time, it worked out that I drew the list at $1 million in revenue on the bottom line, and then 80 on the top. And then I put an or in there to catch some companies, because what you'll have is you'll have VCs and others invest in a company, or maybe they've just got a lot of momentum, and I wanted to catch them. So 10 people or $1 million in run rate, and then 80 million revenue on the top side. So those are tweeners. And then what's not in there, so life sciences are not in there. I am a software guy, so because I created the list, I can kind of define it. And I have no way of evaluating life science companies. So that's like drugs and devices and clinical research organizations. So they're not in the list. And then if it's not kind of something that could be VC backable, it's not in the list. So a pure, like an agency or a software company or a recruiting firm, all those are great companies, and it's not a slight on them. It's just they're not really the kind of company that is targeted here, that we can scale up towards an IPO. They would never kind of go towards an IPO. So then that leaves a lot, and I'm happy to talk about kind of what is on the list and what's not, if you have any other questions about that.
Yeah, so looking back, I mean, when you first launched this, I think there were about 50 companies or so. And I think, yeah, great. So you got some data here, looking at the most recent list, and I think we had a record number. So it looks like really great trajectory, and just wanted to get your perspective on, is how you see this trajectory and this momentum, and what does that tell us about, or what does that suggest for us about, the coming years? And are we in a good place, I guess?
We are. I'm a data nerd, and it makes me wish we had this exact data for other regions, because one of the first
Yeah.
questions I get is, how does this compare to other regions? And I've put all my energy into just the triangle. So, and there's all these other data sources, and we'll talk about some of them. So there's one called Money Tree, and you can find, and then there's Deal Book or Pitch Book. I always forget. There's all this data out there, but it doesn't have that curation to it, right? So you'll go get these things and you'll look at it and you'll be like, really, we raised that money? And you'll look in there and they'll be like, Epic raised, $2 billion. And then you kind of take that one out. And so it doesn't curate it like I have on this kind of what I would call, and to put investing vernacular on it. So pre-seed, seed, seed plus now is a thing. Series A, Series B, kind of by Series C, most companies have kind of gotten off of this list. But that early stage venturable kind of company, yeah. So it's gone from 50 to kind of call it 230 over the time I've been tracking it. Some of that is me discovering these things are like little gems that are out there that I have to discover sometimes. And in the early days, it was a lot of spelunking and chasing down and finding these things. And now there's a flywheel effect here where companies that are on the list have told me that it is super beneficial to be on the list, because a lot of venture capitalists, there's actually one here today, they'll come into town and they'll say, hey, Scott, I'm flying in from Boston for the day, and I found your tweener list, and could you introduce me to these 4 companies? So that's part of the role I have adopted, I guess, in the triangle is venture capitalist. And then, so that's one, so being on the list has made it easy for companies to raise capital. So that's a benefit. Hiring, a lot of people moving to the area or inside of startups, they have found the list to be super beneficial, because it just kind of narrows down the field. If they want to be in an early stage or mid stage startup, it kind of gives them a hunt list for jobs. I've even had, since I've been a little more public, I've started this Tweener Fund. I've had a lot of the tweener companies come to me and say they've actually gotten a lot of customers from the tweener list. So there's a little bit of a flywheel. Now companies want to be on the list, so they're kind of coming to me, which has made my life a little bit easier. One of the ones I was most excited to discover actually were some UNC grads that started a furniture company, and I'd never heard about them. And then suddenly, like 6 people said, "Have you heard of Nugget?" And I was like, "What's a Nugget?" And then they said, "It's a furniture company." I was like, "A furniture company named Nugget?" And here's these 2 or 3 dudes that had invented this awesome kid furniture, just chugging away, totally off the radar. But it has an e-commerce and a huge technology element to it. And they kind of, it's so popular that they do drops of the furniture, just like Supreme and kind of the streetwear brands do, because they're so popular. And that's an example of one that I found between 2019 and 2020. And it's really fun, because it's kind of a game, Indiana Jones nerd style, of finding these companies and getting them on the list and learning what they do and sharing it with everybody.
So you mentioned the Tweener Fund, and you're an active investor, in a few groups across the Triangle area. But the Tweener Fund is fairly newly launched. I'd love to hear a little bit more about the genesis of that, and then hopefully at the end, maybe I'll hold at the end the recent announcement that we just saw about some of the first investments that you guys have made. But that's up to you. You can tell us now. But I'd love to hear more about the Tweener Fund, and how that fits into the capital landscape for startups.
Yeah, so I've been at this Tweener List thing for 6 years, and the most frequent question I get is, "Hey, could you do this for Wilmington, Charlotte? Could you do this for every city?" And I would love to, but there's this is my passion project, and it's my hobby, if you will, and I have a day job that keeps me pretty busy, so I haven't been able to expand it to other cities. The second, and I started publishing the data in this little chart like you see here. The second question I get is, have you considered, some mechanism for investing in these companies? And so about 3 years ago, I started looking at that, and I couldn't find anything that would meet the criteria I was looking at. Before I jump into that, though, if you look at so the typical venture capital model is you'll raise a fund, and it has like a 5-year investment period and then a 5-year harvest period. So call it a 8 to 10 year life to a venture fund, and it's closed. So you have a fundraising period for hopefully not too long, so like 6 months, and then you're kind of into the fund for 10 years, and then you rinse and repeat. And then within there, that company, the fund will typically do 10 to 20 investments, depending on the size of the fund and the number of investments and the size and all that kind of stuff. But it's in the range of 10 to 20 over the life of the fund. So what they're doing is they're trying to pick these winners. And the general rule of thumb in venture, and you can fact check me on this, is usually kind of like a third are losses. So you totally, the company's failed. This is startup, so it's super high risk. There's a lot of failures. A third, you kind of get your money back, or maybe a little bit more. So that would be called a 1 to 2 times return. And then, a little bit less than a third, you get a pretty good return, and then you have 1 or 2 home runs, and then that's typically it. So when I started looking at this data, I was like, all right, how does the Tweener list stack up? And what draws people to ask that question, it would be interesting to invest in this. If you look at that closure line, there's very few failures in this set of data. So, and then because I'm a limited partner in 3 of the local firms, I have confidential access to a lot of the and I don't publish this, but I know on the backside of that, I have visibility. Other LPs do this, but each fund doesn't see this, which is kind of weird, but that's how it works. So I can kind of pencil in and see what the return on all of these are, and it's pretty good. And so I've always had in my mind, it would be interesting to invest in this basket of stocks. So then I thought about, if you do a VC fund, that's like a full-time job, and I don't have time for that. And then it became very popular within the last 3 or 4 years to very easily spin up these investment vehicles called SPVs, special purpose vehicles. Some people call them sidecars, but it's kind of gravitated towards SPVs. And what you do is you pair that around a syndicate. And so a syndicate is a loosely affiliated group of people interested in investing in these SPVs. We actually have 3 around the universities in the Triangle. So we have the Wolfpack Investment Network, the Carolina Angel Network, and then the Duke Angel Network. I kind of remember it, Dan Can Win. So Dan Can Win is a set of syndicates where you join that, and then you have to be an accredited investor, which means you have to have a net worth over $1 million, and then you can do this angel investing as a group. But what happens is they'll find a company and they'll say, hey, this company, Can has identified this opportunity, and usually there's some tie to the university. Do any of you 1,000 people want to invest? And somewhere in there, maybe 100 raise their hands and say yes, and they'll each put in 5 to 10K, and then they'll create a little SPV, an entity, to then invest that entity into the company. The problem with that is it's a lot of work. So you've got all these syndicate people you've got to keep happy. You got to kind of work the company. Then you got to create the SPV, tell the company you're going to put in $100,000. Then you have to go collect the money from the syndicate members. So there's a lot of people that love that, but that felt like also a full-time job. So then Angel List, which is a very started by this guy Naval Ravikant, if I'm saying his name right. It's kind of one of the luminaries of startups in the Silicon Valley. He started this democratization of angel investing platform called Angel List, ANGEL List, Angel List, and they make it very easy to do these SPVs. So I was kind of familiar with that. And then they came out with this new model, and there was some legislation that allowed this to happen called rolling funds. And I joined several of them as an investor, and I really liked the experience as an investor because it has that flavor of a syndicate. So you put a little bit of money in, and then frequently there'll be opportunities to do more. But then the other nice thing about it is it's totally self-service. So it can be midnight, and I can log in and check what's going on, and I don't have to use 9 to 5 hours to do it. So I went. So after a year of that, I went to 20 or so of the local folks in the Triangle and said, "Hey, if I did one of these rolling funds for the Triangle, ecosystem, would you invest?" And every one of them said yes. And they were like, "Where do I send the wire?" I was like, well, that's a pretty good response. So January of this year, I launched the Tweener Fund, and the way it works is they recommend it's a rolling fund, so it doesn't have any end to it, and it's a quarterly sign up. It's typically how it works. They recommend when you start that you do a year minimum and then $20,000 across that year, or $5,000 a quarter. So launch that, and then in January, and we just crossed. We're closing in on 90 investors very quickly here, and have raised over $2 million for the first year, and well over $4 million for the fund. So what it does is it allows us to the idea here is an index fund. So we'll be making about 10 investments every quarter, so 40 in the first year. And remember, a typical VC is going to do 10 to 15 over 3 years. So it's going to have kind of a frenetic feeling pace to it. But I'm able to do that because the platform is just, the whole back office is handled for me. And I just find the companies say, can we put some money in at these terms? They say yes, and then I'm done. So we announced our first 4 portfolio companies just this week. So excited to really kind of show folks that this community supports the startup ecosystem, and that we're going to put our money where our mouth is and invest into a lot of startups in the Triangle. And not only will we be doing good and hopefully accelerating the flywheel of the ecosystem, but we'll get a good return for doing it as well.
Awesome. Yeah, it's always great to have new capital available for these companies. So on the kind of investment front, the data you showed earlier showed that investments overall were a little bit down in the most recent Tweener list compared to the year prior. There's some caveats there. I mean, the pandemic obviously probably played a part in that. But there were also some big investments that came in that year prior, I think as well, that kind of maybe that was more of an outlier kind of thing. But I'm just curious what 2021 ended up looking like, as we've closed out that year, moving into 2022, and just sort of like, what's the landscape look like? Have we are we going to be able to improve over last year's numbers?
Yeah, and so going back to 2019, that 400 million, a chunk of that's Pendo. So whenever Pendo is really big and a kind of a unicorn, if you will, which in startup world means $1 billion valuation. So when you're $1 billion and you're raising capital, you can kind of throw 150 million logs on the fire, and it's the same as a small startup raising $1 million. So, and then also in there, we had 2. In the venture world, there's growth equity, which implies the investor is going to take a minority stake, so not buy the company. And then those lines have blurred. So you have some of those guys actually going into majority ownership, and then you have private equity companies that used to be buyout firms taking less than 100% and doing minority and only 51%. So it's become hard. It's hard to know what's an acquisition and what's an investment sometimes. So in that 2019 data, we had Pendo raise like 100 million, and then Spreedly, which is one of our fintechs, they did a round of, I think like 60, 80, 90 million. And then we had Archive Social, and there was a couple others that kind of felt like that. And it's hard to know. They're so big, were they acquisitions or investments? Another one is Prometheus, kind of falls into this bucket. So that's it's hard to, and I do know a lot of the confidential stuff. So a chunk of that was actually more M&A than it was investment. So it's kind of mischaracterized in a lot of these data sets. Okay, so 2021 I think will be a really good year, and the COVID implications were interesting. You had, just like anything, it was complex, right? So you had some companies failed fast because of COVID. So there was a company that was in the youth sports category, and they didn't kind of make it through COVID. But any company that had digital, did really well through COVID and accelerated. So, for example, Spiffy accelerated through the front part. We had headwinds, and then we really accelerated kind of the 18 months after. Any company that had, there's these kind of categories of companies, and we have this kind of fascinating habit of putting tech on the end of everything. So there's health tech. Health tech did really well. So we went from a world where everyone's like, is telemedicine really a thing, to like the government opened up telemedicine wide. So, and that creates this desire. Once you're in telemedicine, now you want to see your patient records and have control over that. So in the Triangle, we have a really good set of companies there. Those companies accelerated anything in the fintech or financial and insurtech spaces. Those seem to have accelerated. So I think net, because if I kind of segmented it out, just like those closures, we have a very small number of companies that were in kind of tough categories, and a very large number of the 200-ish tweeners that were in these going digital categories, and they did really well over that 21 timeframe.
Cool. So you started to get into some of the emerging technologies, and I'm just curious, thinking about like ag tech is growing in this area as well, and healthcare IT is a big sector as well. Just curious what you're seeing as far as emerging technologies, any trends, any areas that we're doing really well, or that are starting to bubble up that you're seeing in the Tweener list and elsewhere.
Yeah, so a lot of people say, what is it that's unique about the Triangle's environment, startup ecosystem? And one of them is our diversity of company type. So if there was a pie chart, and I actually have this data, I don't publish it. That pie chart has lots of wedges in there, and there's no dominant wedge. Some are bigger than the others, but there's a lot of wedges in our pie chart, and those wedges are ag tech, health tech, marketing technology. We have Bronto was born here, Channel Advisors in that bucket, and then Windsor Circle and a lot of those companies. We have ad tech, so there's a company Kevel in that space. We have green tech. So there's one of the segments I'm most excited about is green tech. We have this really exploding green tech segment. The one I feel like we could do better on is fintech. So, and in fintech, you have payment tech, insure tech, and all these kind of other techs inside of there, but anything around financials. So I'm really excited though, because we're having a lot more of those kind of spring up in the Triangle. So I've met many recently. Spreedly is in there, and I'm a little jealous because Charlotte's a banking town, and our startup ecosystem is like totally crushing Charlotte's. I think we can all agree on that. Anyway, but Charlotte has a robust, they're kind of a couple years behind us, but they had this one winner that I'm super jealous about. And then also the Beach had a winner as well. And they were both in the fintech category. So if you look at VC dollars, they're going into this category in a massive way. Some of that starts to leak into crypto, we could talk about. But even if taking crypto out, Avid Exchange was like this huge rocket ship in Charlotte, and really this nice unicorn exit that they had. They went public, and then out at the Beach we have nCino. So there was this bank created their own operating system, spun it out as nCino, the letter N, capital CINO, and then that has actually gone public and is another fintech. So we're kind of surrounded by these two fintech winners, one in Charlotte and one in Wilmington, and now I think we're starting to get some activity here. We have a company called Eton Solutions, and they sell kind of like that bank operating system that Live Oak had. They have done it for family offices and wealth providers, so they're getting a lot of traction. We have Spreedly. There's a lot of really cool new startups in the Triangle that you'll see pop up on the Tweener list here soon. I don't want to spoil it, but we're going to catch up on fintech. I feel pretty good about. And then another area where we're under categorized is prop tech. And this is a weird one. So there's the commercial real estate industry and just the real estate world is going through a lot of changes. And there's other regions that have built these kind of software and other technology companies around property management and commercial real estate of various flavors. Punch List is one you hear mentioned a lot out of Atlanta. That's kind of a rocket ship. We've been under indexed on that, but I'm starting to meet a ton of those here in the Triangle, which is good. And I see Jim Roberts in the chat. The evangelist. I'm one of the evangelists of the Triangle. The evangelist of the Wilmington area is Jim Roberts. He's a really good follow on Twitter if you want to see what's going on down at the coast.
Yeah, awesome. Yeah, he's been dropping in some great stuff in the chat. So thank you, Jim, for some of those. So I promised to, I have so many questions I want to ask, but I promised to make sure there was plenty of time for audience questions. So I want to make sure that I leave some space here. So I can't see the whole room, but if people want to raise their virtual hand, someone or I, like I or Aspen or someone else from the Entrepreneurship Center team can call on folks. Any questions from the audience? And there have been a few in the chat as well.
So here's, I'll just, while you guys are doing the hand thing, I'll just read through the chat. Scott, do you invest in the idea of the people? At early stage, I think it's so a lot of VCs use this metaphor of the jockey or the horse, and the jockey being the entrepreneur and the horse being the company and the idea. I believe pretty strongly that at an early stage, it's really the founder and the people, and it's their grit, because what I've aside from Mark Zuckerberg, kind of like drawing a cool thing on his window and suddenly turning it into Facebook, my experience is you have this idea and you pull this thread and you don't know what's coming out on the other side of that thread, and you need to be able to bob and weave. They use the word pivot. I'm not a huge fan of that because it implies like a total restart. It's really more navigate a very complex set of problems to get to the other side, which is success. So, I would say if I had to pick, I would put like 80% on the team and the founder. But then, the space matters too. There was a period of time where everyone started a company, and it's kind of funny. We would do these open pitch events with Bull City Ventures, and everyone would come in and say they were starting a social network and they were going to take down LinkedIn, you name it. And that's fine. It's just like, man, you're just making your life so hard that it's really hard to beat those kind of models. And then so there's this weird flavor of the day where a lot of entrepreneurs, they just like want to do something that's already there and they think they could do a better version of it. Lately, it's been chatbots. Everyone wants to do their own chatbot, and I don't know what the total addressable market for bots are, but there's more chatbots than whatever that addressable market is. So the space does matter, but as long as it's not going into this super crowded space that's hyper funded where you're just at such a disadvantage, then it's the team. I see someone with a little hand up over there.
Yeah, Kyle.
Kyle, you want to unmute and come ask a question?
Yeah, can you hear me?
Hey, Kyle, how are you?
Good. How are you?
Good. Welcome to our show today. What kind of question do you have?
Thanks for having me. Yeah, no, so I was curious. I was actually thinking about this earlier today. So when you're raising money into a fund, so say you raise like $20 million, something like that, you might park 10 million into companies and you still have years to park the other 10 million. Is that working in some way? Do you typically have some sort of investment vehicle that you're parking that money?
Yeah, that's not how it works. So, and it, I would have assumed the same thing you did. So you didn't make a mistake of assuming that. So the way venture capital works is you have, the vernacular is you have GPs, so general partners, and those are the investors, the venture capitalists. And then you have LPs, limited partners, and that's the money source. So what you do is you say to your LPs, hey, I'm going to do, I'm Kyle and I'm going to do Kyle's fund. And I would like 100 of you to put $1 million in. So then you raise 100 million. But what you're doing is you do it over time. So you say, I'm going to deploy this capital over 3 to 5 years. And then what you do is you do capital calls. So then you say to them, to get started, I'm going to need, I know you've each committed to $1 million, I'm going to need 100,000. So then you pull in that capital, you pull in a very small slice, you invest it, and then you pull in it, you do another capital call and pull it in and another capital call. So the limited partners, they don't want you to just take all that money and sit on it over time. They want to deploy it in small chunks. So that's how it works. It's called a capital call.
Okay. I appreciate it.
Yeah. And I'm sure, these are such big numbers. I'm sure there is, but they would never put it in anything riskier than cash. But, so maybe like the equivalent of a money market fund that was, but that money, if they lost that money, that would be doomsday. So they would not deploy that into anything with any risk at all to it.
Okay. Interesting.
Yeah. Thanks for the question. Eric, you want to go next?
Yeah, thanks, Scott, for coming. Two quick questions that I had. Besides like Raleigh Founded and NCI Deer, do you think the Triangle is missing, any incubators for the area when it comes to like Techstars or any of those more national? Um, and as well as, when do you think we will start seeing, some spin outs out of Epic Games or Pendo, like you kind of see, in the Silicon Valley from those big unicorn startups?
Yeah. So two questions there. So I'll take the first one. So the first one was, so we have, so you have co-working spaces, right? Generically, like WeWork is kind of one, and then we have some that kind of layer in a startup ecosystem. So we have American Underground on one side of the triangle in Durham, and then in the other side of the triangle we have Raleigh Founded, which used to be called HQ Raleigh. There's another one, Co-Founder Capital. Also, you can go and carry and kind of work with them, and they put a lot of their companies inside of there with investments. But anyone is welcome to go and sit and hang out and soak up the entrepreneurial vibes at Co-Founders. Every one of our universities has some kind of a co-working space. So there's Launch UNC. There's NC State has partnered with Raleigh Founded for one on Centennial Campus, and I apologize, I don't know what the Duke one is, but I'm sure they have one. It's funny, like when I first did this, there was like 3 people in the triangle at universities that cared about startups, and now I can't keep track of all the programs going on, so it's a high class problem. To your point, so then your question was, what about accelerators? And then just so everyone knows, is this accelerator model was born in Silicon Valley with Y Combinator, and the idea was you submit, they have this application process. You submit, and you're either allowed in or not. When you're allowed in, you're in a cohort. So they would run a program almost like a university class, if you will. And then once you get in there, they come with money, and then you agree to go as an entrepreneur and run through this program. And it can be 2 or 3 months, something like that. And then you graduate, and then they do a demo day at the end. Very quickly out of Denver, another company started called Techstars, and they kind of have a similar model with a different flavor to it. Those are called accelerators. And what's nice about them is they do kind of come with money. And this typically started out at 50 to 100K. And then I think Y Combinator just cranked up to 250 or 500K. They've made so much money at this. So in the triangle, we actually have Techstars did a thing with MetLife where they did an InsurTech accelerator. I think that's on pause due to the pandemic. We have Bunker Labs, which is for veterans. And I think it is similar. For a while, we had a game-oriented one. I think that one is no longer going. And then we've also, I think some of the, don't you guys have Andrews Accelerator? What's the one? Adams. I think UNC has Adams, and NC State has, let me see, Adams and Andrews. I think I think NC State has Andrews and UNC has Adams. Am I misremembering that? So a lot of the universities do have like a little bit of an accelerator in there, but it's really for students that have kind of come up through entrepreneurship that are in there. And it typically has like maybe 25, 50K, and maybe some of it doesn't even have dollars associated with it, free room and whatnot. So yeah, so I do wish we had more of that here. And I wouldn't be surprised if we see more coming. All right, so that was a long answer. The second part of your question, can you restate that again?
Yeah, with Epic Games and
Epic
their
Games.
success,
Yeah.
and also Pendo, spin outs from those or other, you know.
Yeah. Yeah, so rewind the clock a little bit, and where we've seen a lot of companies come out of is Red Hat, and then IBM here and Cisco. So we've seen a lot of companies come out of that. Service Trade, for example, is a Red Hat sales leader that came out and started a business, and that just had a really nice, I don't know if it was an investment or exit, but a big chunk of equity, like something like $80 million plopped into that. So I could probably count 5 to 10 Red Hat companies that kind of came out of Red Hat being here in the Triangle. There haven't been a lot that comes out of SaaS. So part of the old school nature of SaaS, and I'm talking about SAS, the company, not SaaS, the business model. It's really tricky to talk about that. But the company in Cary that does statistical software called SaaS, not a lot of startups come out of that because part of their, it's just kind of like not part of their culture, if you will. You go there, and so for example, on the technology side, they have their whole own programming language. So once you get in there and you're there for, you spend your first year learning their programming language, it's almost designed to make it hard for you to leave, and which is very clever. I'm kind of jealous about that idea, and you couldn't really do that today. But you don't see a lot of entrepreneurship come out of SaaS. There has been some, but not a lot. One of the things I'm proud about is the company I started, Channel Advisor. So there's a CEO of a company called RepView. He was at Channel Advisor. The CEO of Spoonflower is out of Channel Advisor. And a lot of the team at Channel Advisor has gone on to either start or be leaders at a bunch of other startups here. Levitate, their chief revenue officer, Grant Kitching, came from Channel Advisor. So I like to think we sprinkled a lot of entrepreneurial goodness across the triangle there. And then I do think I'm excited about Pendo. I think it's too early. I think it would be kind of foolish to leave Pendo until they have a really big exit event. But when they do, I think we're going to see a lot come out of that one. That could be everyone's jealous of Silicon Valley's PayPal mafia. That if you look at that company, there's been more startup juice that came out of that than almost anything. LinkedIn, YouTube, Max Lycan at Affirm. There's like a bazillion things that came out of PayPal. I think Pendo could be that company that really cracks it open for us.
I'm gonna steal an opportunity for a question, Scott. Since you talked about it a little bit at the beginning, and that you have a preference for IPO, and that you think it's an important kind of catalyst for the area. Can you talk a little bit more about that? You've been talking about it now. Can you talk a little bit more about that, and maybe what's the right, I guess two things associated with that. One is like, what do you think the short-term opportunities are beyond Pendo, and what's the right balance? So, I mean, and what's the importance of IPO versus a large acquisition where at least any of the shareholding early joiner types, hopefully do well, kind of thing.
Yeah, let me start it kind of like once. So in startup land, there's kind of 4 outcomes. Number one is you fail, and that's actually tends to be a pretty high probability, and no one wants that, but it's always looming out there. Number 2 is a lot of companies start, and then they kind of get to this they kind of flatten out and they get to this trajectory like this, and there's nothing wrong with that. Kind of famously here in the Triangle, we have one called Etix that has done really well, but they've never broken out into kind of like that big company thing. So they just kind of got up to a certain scale, and it's a good scale, but they just decided that's kind of where they're going to be. And then the other one is you get big enough that you get acquired. So that's number 3. And then number 4 is you get big enough. And typically this varies. This is a rule of thumb. You need to be in that 80 to 100+ million revenue range to go public. So the thing a lot of kind of student entrepreneurs don't realize is once you take venture capital, option number 2, kind of riding it up and then coasting, is off the table. Investors don't want that, and they actually build into the whole setup is that that option's off the table. So now you're down to 3: fail, M&A, and IPO, and then they really don't want you to fail, so you're really kind of down to 2. And then, so you really signed up to deliver returns, and it's not like you said, I will guarantee it, but you kind of have, right? So a first-time entrepreneur, it's really hard. So being there, I was like, I started when I was 25 and I was 29 when I did this. By the time I sold my first company, it was ridiculous. I had a net worth probably of $30,000, being super generous if you valued my beat-up Honda Accord that had 150,000 miles on it very generously. And I had personal guarantees of $2 million, because every time I would sign a lease, they'd look at me and say, you're 25, you can't really rent a car, you can barely drink beer. I'm going to need some guarantee for you to have this office space or to do X, Y, and Z. So it's got to the point where it was ridiculous. And then the other thing no one ever tells you is when you own a big chunk of a company, you can't get a mortgage. So it's funny. We had brought a guy in from China on an H-1B, and he got a mortgage easier than I could as the business owner. So there's a lot of stuff's kind of backwards when you're a first-time founder, and you're just kind of like, holy cow, why is this so hard? But then I had my first success, and then I could kind of like, I could take some money off the table and then really go at it, and I could have a lot more risk. So I don't begrudge first-time founders for selling, and I think that's actually probably the best outcome as an M&A for a first-time founder. What's nice though now is when that was kind of the 95 to 2000 kind of options. Now a lot of investors come in and they don't mind giving the founders letting them take some money off the table. That's called secondary shares. So when a VC comes in, they're typically putting in money for shares the company creates called primary shares. But then if there's existing shares, they now are interested in buying some of that. So like the Spoonflower guys did that, where they got it up to a certain rate, they took some money off the table and kind of de-risked their own personal balance sheet, and they took it another step, which was interesting. All right, so I like IPO better than M&A if putting aside all that and first-time founders, because I think if you can kind of keep going and you're growing the business, push to that last piece to do the IPO, because what we do is most founders, they give equity to their employees. And that's where you get that boom wealth effect of, at the ChannelAdvisor IPO, we had, obviously the investors did kind of 10x, but we had, our VP, director, and even manager levels made, a manager may have made like $200,000 to $400,000 from that, and then other people making millions of dollars off of that event. And it typically, the other nice thing is you can get long-term capital gains from an IPO. You can't really do that in most M&A scenarios because there's an immediacy of it and a cash, and it doesn't have that 1 year hold that you can get with an IPO. So that's a very kind of a long answer, but hopefully you learned something as I explained that about why I like that IPO, because it spreads the wealth and plants more entrepreneurial seeds in the community, I believe, than an M&A. Let's see. Any other questions in the chat?
Time for one or two, maybe quick questions.
Someone asked, becoming an accredited investor means having $1 million you're prepared to commit. No, the accreditation, so the SEC is there to protect consumers, and they come up with these rules. The Securities and Exchange Commission, which is a government body, and they come up with a lot of rules around investing, and they're generally really good. And one of those rules is they want to avoid the little grannies that are being preyed upon for people trying to get their dollars and essentially scam them. So what they've done is they've said to invest in private companies, you need to be accredited, and you have to go. If you Google it, you'll find the definition on the SEC site, and it's like way more complicated. So take this with a grain of salt. It basically says your net worth needs to be $1 million, excluding your primary residence. So what they want to do is they want to see that you're relatively sophisticated and that you kind of know what you're getting into. And whenever anyone invests in startups, I always say you could lose all your capital because this is a very risky thing. 2008, the failure rate went way up. There's externalities that cause startups to fail. You could lose your capital. So that's where that is. Ironically, we're in this weird period though, where you have to have $1 million, and I'm looking at the students here, and I have two kids that just graduated from college, so you have to be accredited. On one side of the world, there's this accredited world where you have to have $1 million and there's all this safety, but any of you could fire up Robinhood and invest in stocks that are kind of crazy, SPACs and crypto and NFTs and Dogecoin and all that stuff. So it's this really weird world where you have, you can't invest in this startup world, which I would argue personally are much less risky than crypto, a lot of the crypto coins and some of that kind of stuff. And you can do public companies, which have a lot of risk, but there's this one asset class you don't have access to as a student, because asterisk, unless you're accredited. So these things over the long arc of time, they settle out. I think it'll actually be that the crypto will get regulated, because I think there's going to be there'll be regulation put on crypto, and then I think the SEC is starting to kind of see, and there's these new crowdfunding things that are making it a little bit easier for the individual to invest in startups. So it's kind of a hot mess right now, though.
Hey, Scott, I had one question. I'm curious, as younger generations become CEOs and founders of these startups, are there certain characteristics that you're observing from maybe younger founders versus other generational founders at a macro level?
Yeah, and it makes me, so I'm super jealous, right? So I've kind of learned all this stuff through the School of Hard Knocks. then I'll meet like I don't know what your situation is, but I'll meet folks that come out of one of our 3 universities programs, and they'll have gone through all this entrepreneurship stuff, and so they're 21 to 25, and they already know all the vernacular, and they have all this knowledge that it took me 10 years to get. So what I find is, in these first time entrepreneurs, is there's way more content out here now than there were in the early days. So they totally get it, and their ability to analyze startups. They've already started 3 companies. They've got 6 side hustles, and they're really kind of zeroing. My only advice to them is to focus. So they get so they're like, I've got this NFT project, I'm doing this, and that they're so spun up about entrepreneurship, they're doing too many things possibly. Who am I to judge that? I'm the guy sitting here in front of you with about 15 things going on. I admit there's a hypocrisy in there. So that's what I would say is they're like really, they're at where 35-year-olds were 5 years ago, and they're at where 50 years, they're just kind of like at a whole different clock speed, to kind of put an analogy on it. Is that what you were asking? The other element I would say is just like millennials, there tends to be a societal impact. They want to not only want to make money, but they want to put a dent in the universe. It's kind of like how I'd say it. They're like, I'm going to solve climate change and make money, or I'm going to, so there's always like a really cool element to that. And, and they're savvy enough to know they kind of need to do both. Right. And so there's kind of social capitalism kind of thing going on that's kind of interesting.
Yeah, that was going to be my follow-up. So thank you.
So I think we are at time. Jen, did you have any last words that you wanted to say?
Well, I wanted to thank everybody for joining us this evening. And I also wanted to highlight that we do have 2 upcoming events in February. If any of you had followed the Frontiers of Entrepreneurship conference that usually takes place down in Florida, we, of course, moved that to a virtual conference this year due to the Omicron variant. But many of the sessions that were planned in person are now being pulled out into individual sessions. And so one of the sessions was a fireside conversation between Ted Zoller and Emmy Abramson. Emmy is an MBA grad of Kenan-Flagler from 2004, and he's the co-founder of Nearpod, which had a very successful exit last year. And so that will take place February 16th from 5 to 6 p.m. I think if you received any of our emails, you may have seen already the registration link for that. And then the second one, we're still working out the details, but will take place Thursday, February 24th. So we've been doing these innovation series, speaker series, the last Thursday of every month. And so in February on the 24th, Rodney Sampson, who leads our Diversity, Equity, Inclusion Solutions class and Black Technology Ecosystem Investors class through our Scale School, is hosting a panel to talk about minority entrepreneurship and investing in that asset class, and bridging the gap a little bit in our diverse entrepreneurs. So just wanted to plug those 2 events, and thank you all again for being here, and thank you, Scott, for all the wonderful insight.
Thanks for having me. Really appreciate it. Thanks, everybody.
Thank you, Scott. Thanks, everyone.